Did you know that 60% of Americans struggle to save even $1,000? And for those who do, reaching a six-figure net worth feels like an insurmountable challenge, a financial Everest. Many give up, believing significant wealth is only for the privileged few. They save diligently for years, only to see slow, almost imperceptible growth, leading to frustration and burnout. But what if I told you there's a specific financial threshold, a tipping point around $100,000, where your money starts working asterisk for asterisk you, exponentially accelerating your wealth journey? The $100,000 mark isn't just a number, it's a profound psychological and structural milestone. It signifies financial legitimacy, moving from saving to investing seriously. For many, it's the first time they've accumulated a substantial sum that feels real. It shifts your mindset from scarcity to abundance, from hoping to achieving. Consider this: accumulating your first $10,000 might take years of disciplined saving. Reaching $50,000 feels even harder. But the next $50,000 to hit $100,000. That's where the magic begins. The initial phase of building wealth, from $0 to $100,000, is often called the heavy lifting stage. Your personal savings and consistent contributions are the primary drivers. Compound interest, often called the eighth wonder of the world, is the key. It's interest on interest, where your earnings generate more earnings, creating a powerful snowball effect. In the early stages, with, say, $10,000 invested at an 8% annual return, you're looking at $800 in earnings per year. That's good, but it won't make you rich overnight. At this stage, your savings rate and consistent investments are paramount. You're building the foundation, pouring concrete, brick by brick. Every dollar contributed matters immensely. Let's say you save $500 monthly. That's $6,000 a year. If your portfolio is $50,000, your personal contributions still far outweigh your investment returns in absolute dollars. You're essentially fueling the engine yourself. The portfolio growth from market returns is helpful, but it's like a gentle tailwind, not the main propeller. Then, you hit $100,000. Congratulations! This is where the dynamic fundamentally shifts. Your money, now a significant sum, starts to earn serious money on its own. The subtle shift is this: your investment returns begin to equal, and then quickly surpass, your personal contributions in terms of absolute dollars added to your portfolio. A 7% annual return on $100,000 is $7,000. That's a significant chunk of change, often exceeding what many can save from their monthly income after expenses. Compare that to $50,000 at 7%, which is only $3,500. You've doubled your passive income from investments by simply doubling your principal. This larger absolute gain provides a powerful psychological boost. You see tangible evidence that your money is generating substantial income, validating your efforts. This is the hockey stick moment for wealth. The growth curve starts to bend upwards significantly. Your money truly begins to compound in a noticeable, accelerated fashion. With $100,000 invested, even modest market returns of 7–10% annually generate between $7,000 and $10,000 per year. That's real money without you lifting a finger. Think about it. $8,000 annually from investments is equivalent to saving an extra $666 every month. For many, that's a significant portion of their discretionary income. And here's the kicker: that $7,000 or $10,000 itself gets reinvested and starts earning its own interest. This is the true power of compounding unleashed. The effort required to grow your portfolio by the next $10,000 or $20,000 becomes significantly less dependent on your direct contributions. Your money is doing the heavy lifting. Your portfolio can now earn more in a year than you can realistically save from your paycheck. This is the point where financial independence starts to feel genuinely attainable. This also means the impact of reinvesting dividends and interest becomes far more substantial. A 2% dividend yield on $100,000 is $2,000, which can buy meaningful new shares. With a solid base, you gain more flexibility. You can consider slightly more diversified strategies or even allocate a small percentage to higher growth, higher risk assets. To reach this threshold, focus on maximizing your savings rate. Automate your investments, even if it's just $50 a week, and consistently increase it as your income grows. Secondly, minimize fees. High expense ratios can eat into your compounding, especially when your principal is growing. Opt for low-cost index funds or ETFs. The $100,000 threshold isn't the finish line, it's the launch pad. It's the point where your wealth journey shifts gears and the true power of compounding takes over. The next milestones, $250,000, $500,000, and eventually $1 millions will feel faster, easier, and much more achievable. Keep saving, keep investing, and let your money work for you. You've hit that first financial milestone, a commendable achievement. But the journey doesn't end there. Many investors, after initial success, find their wealth growth stagnating due to subtle behavioral traps. Chapter 2 explores 3 critical pitfalls: cognitive biases, misguided risk management, and the destination effect. Understanding these can unlock your next phase of accelerated wealth accumulation. First, cognitive biases. Overconfidence, especially after a successful early investment, can lead to taking on excessive, uncalculated risks. You might believe you're invincible. This often manifests as concentrating capital in a single high-flying stock or sector, forsaking diversification. For example, allocating 50% of your portfolio to one tech giant after a lucky early gain. The reality is grim data shows over 80% of active traders underperform the S&P 500. Concentrated bets, while potentially lucrative, carry asymmetric downside risk that can wipe out gains quickly. Action: reevaluate your portfolio allocation. Ensure it aligns with your long-term risk tolerance, not just your recent wins. Rebalance to maintain appropriate diversification across asset classes. Another bias is loss aversion. The fear of losing accumulated gains can paralyze decision-making, leading to a status quo bias where you cling to underperforming assets. You might hold on to a stock that's down 20%, hoping it'll recover, rather than cutting losses and reallocating to a higher potential investment. This isn't rational, it's emotional. Research indicates the average investor holds losing stocks 50% longer than winning ones. This behavioral trap prevents capital from being deployed efficiently, hindering overall portfolio growth. Action: implement clear exit strategies. Set stop-loss orders or specific rebalancing rules. Review your portfolio quarterly, ruthlessly cutting underperformers to free up capital. Confirmation bias leads you to seek out information that validates your existing beliefs, ignoring contradictory evidence. If you're bullish on a sector, you'll only read articles supporting that view. Similarly, anchoring bias means you fixate on an initial price or expectation, even when market conditions change drastically. This prevents rational adjustments to your investment thesis. Next, misguided risk management. Some investors become overly cautious after accumulating wealth, shifting entirely into low-yield, safe assets. This conservative approach can actually erode purchasing power. For instance, moving all your capital into a savings account yielding 0.5% when inflation is running at 3%. Your money effectively loses 2.5% of its value each year. At a consistent 2% inflation, $100,000 in cash could erode to approximately $80,000 in purchasing power over just 10 years. You're losing money by trying to be too safe. Action: maintain a diversified growth portfolio appropriate for your long-term goals. Even in retirement, a portion of your assets should be allocated to growth-oriented investments to combat inflation. Conversely, some investors take on too much risk, driven by overconfidence or the house money effect, where they feel freer to gamble with profits. This can lead to chasing highly speculative assets like meme stocks, volatile cryptocurrencies, or options trading without a robust strategy, often fueled by FOMO, fear of missing out. The statistics are sobering: roughly 90% of day traders lose money. This isn't a strategy for sustained wealth building, it's a high-stakes gamble with dismal odds for most. Action: define your true risk tolerance and stick to it. Avoid impulsive decisions driven by market hype. Focus on long-term, diversified strategies and regular rebalancing to manage risk. Neglecting rebalancing is another common error. As some assets outperform, your portfolio's original allocation shifts, potentially increasing risk without you realizing it. If equities soar, your equity exposure might grow from 60% to 80%, making your portfolio much more vulnerable to a market downturn than intended. Rebalancing is key. Finally, the destination effect. After hitting an initial financial goal, many investors become complacent, reducing their savings rate or losing the urgency to optimize. You might increase discretionary spending, buy a new car, or take more vacations, without adjusting your financial plan. This new lifestyle can quickly outpace your passive income growth. Even a modest $5,000 reduction in annual savings can cost you over $100,000 in compounded wealth over 15 years. Every dollar saved and invested still matters immensely. Action continuously set new, higher financial goals. Think beyond the immediate milestone. What's your next target? $250K? $500K? $1 millions? Keep stretching your vision. Without clear next objectives, you risk drifting. A lack of a defined roadmap can lead to stagnation, as there's no longer a compelling reason to push for further growth or efficiency. This isn't about chasing arbitrary numbers, but about aligning your capital with your evolving life goals. A passive approach without active goal setting is a missed opportunity for exponential growth. The destination effect also involves shifting focus away from continuous optimization. You might stop reviewing expense ratios, neglecting tax loss harvesting, or delaying estate planning. These seemingly minor oversights can collectively cost you hundreds of thousands over decades. A 0.5% higher expense ratio on a $500 K portfolio costs $2,500 annually, compounding over time. Action: treat wealth management as an ongoing process, not a one-time event. Schedule annual financial reviews covering all aspects: budgeting, investing, taxes, and estate planning. Avoiding these behavioral traps is crucial for continuous wealth growth. Stay vigilant, stay rational, and consistently optimize to ensure your financial journey never stagnates. After hitting that initial six-figure milestone, the next phase isn't about speed, but precision. We're building a robust financial foundation, systematically optimizing every dollar. This chapter focuses on a systematic investment hierarchy. It's about ensuring every dollar you earn is working as hard as possible, minimizing tax drag and maximizing growth potential. First, cash flow optimization. Understanding where your money goes is paramount. Track every expense for 30 days. Tools like Mint or Personal Capital can automate this process. Once you have clarity, automate your savings. Set up direct transfers to your investment accounts immediately after payday. Make saving the first priority, not an afterthought. Consider the 50-30/20 rule: 50% for needs, 30% for wants, 20% for savings, and debt repayment. Adjust these percentages to fit your unique financial situation and goals. Next, establish your emergency fund. Aim for 3 to 6 months of essential living expenses. This isn't for investing, it's your financial cushion. Calculate your monthly essential expenses: rent/mortgage, utilities, groceries, insurance. Multiply that by 3/6 to determine your target. For example, if it's $4,000, aim for $12,000 to $24,000. Keep this fund in a high-yield savings account. It needs to be liquid and safe, not exposed to market volatility. Look for accounts offering 4% APY or more. Once your emergency fund is secure, leverage employer benefits. The absolute first step for many is contributing enough to your 401k to get the full employer match. This is essentially free money, an immediate 50% or 100% return on your contribution. For example, if your employer matches 50% on the first 6% of your salary, contribute at least 6%. Missing out on the match is like leaving a guaranteed bonus on the table. It's the most impactful financial decision you can make at this stage for immediate wealth acceleration. Next, consider a health savings account, or HSA, if you have a high-deductible health plan. This is often called the triple tax advantage account. Contributions are tax-deductible, growth is tax-free, and withdrawals for qualified medical expenses are also tax-free. It's a powerful tool for both health and wealth. In 2024, you can contribute up to $4,150 for self-only coverage or $8,300 for family coverage. If you're 55 or older, you get an extra $1,000 catch-up contribution. Once your HSA is funded, invest the balance. Many HSA providers offer investment options, allowing your health savings to grow alongside your retirement funds. Beyond 401k and HSA, explore other employer benefits, flexible spending accounts (FSAS), commuter benefits, or employee stock purchase plans (ESPS). Each offers unique advantages. Now, let's turn to individual retirement accounts eras. Decide between a Roth IRA or a traditional IRA based on your current income and future tax expectations. A Roth IRA offers tax-free withdrawals in retirement, ideal if you expect to be in a higher tax bracket later. Contributions are made with after-tax dollars. A traditional IRA provides a tax deduction on contributions now, suitable if you're in a higher tax bracket today. Withdrawals in retirement are taxed as ordinary income. For 2024, the contribution limit for IRAs is $7,000, with an additional $1,000 catch-up contribution for those aged 50 and over. Max out your chosen IRA annually. After maxing out your 401k match HSA and ERA, turn your attention back to your 401k or 403b to contribute beyond the match, up to the annual maximum. For 2024, the maximum contribution to a 401k or 403b is $23,000. If you're 50 or older, you can contribute an additional $7,500. These pre-tax contributions reduce your taxable income now, lowering your current tax bill. They grow tax-deferred until retirement, allowing for more aggressive compounding. If your employer offers a Roth 401k option, it combines the high contribution limits of a traditional 401k with the tax-free withdrawals of a Roth IRA. This is a powerful choice for those anticipating higher tax rates in retirement. Your after-tax contributions grow completely tax-free. Finally, after exhausting all tax-advantaged accounts, consider a taxable brokerage account. This offers ultimate flexibility and no contribution limits. While taxable, these accounts allow you to invest in a wider range of assets and access your funds at any time without penalty, offering liquidity for non-retirement goals. Remember, long-term capital gains are taxed at a lower rate than ordinary income, typically 0%, 15%, or 20% for most investors. This systematic approach ensures you're maximizing every tax advantage available, from immediate deductions to tax-free growth and withdrawals. Review your financial setup annually. Tax laws, contribution limits, and your personal circumstances change. Adapt your strategy to remain optimized. Your financial journey is a marathon, not a sprint. Patience and consistency in following this hierarchy will yield substantial long-term wealth. The power of optimized cash flow and tax-advantaged accounts isn't just about saving money, it's about making your money work harder for you, silently and efficiently. Embrace the sloth's wisdom. Slow, deliberate, and optimized steps lead to exponential results. This systematic approach is your bedrock for enduring wealth. In the next chapter, we'll delve into strategic asset allocation and diversification to further accelerate your wealth accumulation while managing risk. Stay tuned. We've navigated the $100K milestone, overcome behavioral biases, and optimized cash flow. Now, let's build a minimalist, resilient portfolio designed for effortless, long-term growth. Forget complex strategies. Our goal is maximum impact with minimal effort. This chapter focuses on simple, powerful investment vehicles that deliver consistent results without daily stress. The cornerstone of a low-effort portfolio is index funds. VOOS and P500 ETF and VIXIS Total International Stock ETF offer broad market exposure and diversification with expense ratios often below 0.5%. For stability, especially as you approach financial independence, consider a bond ETF like BND Total Bond Market ETF. A 70/30 stock-to-bond allocation can significantly reduce volatility, maintaining growth. A classic lazy portfolio might be 60% VOO, 20% VIXIS, 20% BND. This simple three-fund strategy has historically outperformed many actively managed funds over decades, saving you fees. Set up automated contributions to these funds through your brokerage. A consistent $500 monthly investment, compounded over 20 years at an 8% average return, could grow to over $260,000. Beyond public markets, smart real estate offers diversification. Consider rate real estate investment trusts like VNQ Vanguard Real Estate ETF for passive exposure to diverse property types and steady income. For direct property, understand your local market. Identify areas with strong job growth, low inventory, and favorable rental yields. A 1% rule monthly rent, equals 1% of purchase price is a quick screening tool. Focus on cash-flowing properties or syndications. A single rental property generating $500 monthly net profit adds $6,000 annually to your passive income, fueling further investments effortlessly. Don't over-allocate to one asset. A balanced approach might be 70% stocks/bonds and 30% real estate direct or rates, depending on your comfort and market access for optimal growth. Rebalancing isn't about daily trading. Once a year, check your portfolio. If stocks surged, sell some to buy bonds. If real estate lagged, consider adding more. Keep it simple and low stress. Once financially independent, strategically withdraw from tax-advantaged accounts, first Roth, then traditional IRA/401k to minimize your tax burden. Understand the 4% rule for sustainable income. Never neglect your emergency fund. 6-12 months of expenses and adequate insurance, health, life, disability. These are the bedrock, protecting your long-term growth from unforeseen events. True wealth isn't built overnight. Embrace patience, ignore market noise and daily fluctuations. Your consistent, automated contributions are far more powerful than trying to time the market. Sometimes, the best strategy is to do nothing. Let compounding work its magic. Avoid impulsive decisions driven by fear or greed. Stick to your plan. Be the unbothered sloth for optimal results. While our strategy is simple, stay informed. Read foundational books like The Simple Path to Wealth. Adapt your plan as life changes, but always within your minimalist, low-effort framework. Your action checklist: 1. Set up automated contributions. 2. Choose 2-3 low-cost index funds. 3. Research local real estate or rates. 4. Schedule annual portfolio review. 5. Automate emergency fund top-ups. Resources for your journey: explore tools like Personal Capital for tracking, Vanguard/Fidelity for low-cost funds, and Bigger Pockets for real estate insights. Education is your greatest asset in this pursuit. This journey is about consistent, mindful action. Start now. Stay disciplined. Remember, complexity often hides inefficiency. Embrace the minimalist path to lasting financial freedom. Don't be lazy with your future.